Welcome back to the new season of Primary Source China Investment. This is show A4. Peng Guo and I are excited to get into it. And based on some feedback, we're going to give you the lead and then get into why we come up with that summary. So the lead this week is alpha is dead, but you can still really screw up beta. So what does that mean, particularly for China? Like a lot of stock markets, China is down year to date, and everybody's taking it on the chin. But active management didn't shield investors, and in some cases actually made the pain worse. And we want to be accurate in describing these alpha and beta and different markets, because you have to define the market before you can look at alpha and beta. So the first up is the mainland. And our viewers know that the CSI 300 is the major market index for the mainland, A shares. And in the US, that's traded under ASHR. And that tracks the 300 largest stocks on the mainland. In finance parlance, this is called the market, or beta. And there's not a lot of pure play A-share actively managed funds, but there's a couple, and we took a look at them this week. Before we get into that, Peng Guo, on the mainland, we're defining the market as CSI 300, but there's a lot of other things to consider.
That's true. I think firstly, most important things is what's the expectations from the investor. Yeah. So I think in my understanding, the real expectation for all the investor is like the Shanghai Composite Index. So if this one gets the positive return, no matter what happens, your portfolio should beat this index. However, if this gets a significant negative return, they want you to control the downside risk.
Right.
So that is a real expectation for all the clients. Otherwise, they will just withdraw the money.
Yeah, yeah. So we didn't look at Shanghai Composite this week, but you bring up a good point. Shanghai
CS 300 is also is also the major one. Same thing, it's like the Shanghai Composite.
Yeah, it's just the difference for our viewers. The difference, Shanghai Composite, obviously only all the stocks in Shanghai, and then CSI 300 is Shanghai and Shenzhen, and Shenzhen is a big market. So we looked at some of the actively managed funds, and some of these people have been doing it a long time. In terms of performance, the worst one we saw was CAF. And this is interesting because it's Morgan Stanley's fund. It was launched in 2006, and it has about 270 million under management, which is large for a China fund. They've been in the game a long time. They have presence on the ground. They have analysts on the ground. These are so-called smart people. Next up is HSHAX. It's a very small Hartford Schroders fund, also underperformed. And then you have right in the middle, ASHR. That's got about 1.5 billion under management. So that's the index. Then we had a couple that did outperform. There's a Bailey Gifford fund and a BlackRock fund. Both outperformed by about 125 bips. No need to get too excited here, because outperformance when you're down 35% is outperformed by 1% when you're down 35% is not great. So you're going to hear in the next 2 months, when the year comes to the end, that 2023 is going to be a stock picker's year. Don't believe it, because this is the year where active managers should have outperformed, and they absolutely didn't.
Still have the two things. One is from investor perspective, another one from investment team's perspective. So most of the investment team, they follow the Western's investment style. So they buy and hold, which is we say this one doesn't work in China at all about 5 years ago. The reason is it's still the beta itself. So like the US SP 500, the beta, if you see the SP 500, is almost 0.7 to 0.8. But most of China's beta is probably around less than 0.5, like 0.4, something like that. If you follow up such a kind of index, you absolutely die. So it's not just lose the money, you absolutely die someday. No matter you get the good market like the 2007 or 2015, you can be hero and then you will die pretty soon. Another very important concept is always get argued: relative return or absolute return. from investment perspective, they always pursue the relative return. Looks like an immune responsibility from them, but absolutely true if from the investor's perspective. But that's just increase the hard for the many investment team because they don't have the capability to generate the absolute return. They may have an ability to create the relative return, but in the market crash, that's the major risk in the emerging market. So that's you just heard all the investors, and most of them just withdraw money and never come back.
Yeah, it's hard. Alpha is hard anywhere, right? You're going to see in the U.S. this year, market is down. I don't know, S&P is down 20%. Call it this year. 25%, depending on what day. We just had a big run up this week. But to get even relative performance in a developed market is very difficult. The argument has always been emerging market is where you need active management. That's a canard. That's just not true, because if you are fully invested, and again, most investors looking at China, they are looking at an allocation and they're going to be fully invested. They're not going to go in and out. And
that's true.
Managers have failed to perform, have failed to protect. So you should just buy the index. And it's even more pronounced when we get to Hong Kong. So let's look at the story of Hong Kong, because if you look at the names that are traded, the largest names in Hong Kong, they're actually very boring, long-standing mainland companies, a lot of financial companies, insurance, and that actually did pretty well this year. So, EWH is probably the best proxy for Hong Kong listed stocks. And there's no surprise that was down this year, was down about 29% year to date. But all of the active managers in Hong Kong got sucked in by this groupthink of China tech. So again, all these great names. We had Goldman Sachs, AllianceBernstein, Matthews, who's been doing this probably longer than anybody. All of these names, they all underperformed this EWH by a lot. So it's very, very difficult to ascertain which managers might actually outperform. And if you are wrong, you risk being down much more. So it's not a win to say, oh, I had 29% down and everybody else had 40% down. But on the way back, that 10 points is a lot to make up.
That's triggered a very good question. So what's the real value for the investment manager? So there's a couple of plays. This I think, especially in the equity investment, most investment manager, their value is like the stock picking. So they understand a certain industry. So it's more like the stock level and the sector level. They are the expert. But at this time, the risk or the big change is really from the entire market level and the cross-country, the whole global level. And also, they have a lot of investment constraint. For example, they must hold it. They cannot sell and liquidate their holdings.
There's no way to convince investors that you can market time and pick stocks. So
that's true.
If you allow them to go in and out of cash stocks, I would submit you'd even have worse performance, because what they're demonstrating right now is they can't pick stocks. Because if you could pick stocks, this would have been the year to do that. You would have been in energy, you would have been in healthcare. They didn't do that. They didn't rotate out. They actually went double-fisted into tech in Hong Kong, for example. And that's been a horrible, horrible trade. You and I have talked about this many, many times. We told investors, avoid that. A year ago, we were slamming Ray Dalio to do, for doing that. So, you and I knew that. I can't imagine Goldman Sachs didn't know that. But when you look at the results, you see they didn't outperform the index and actually underperformed in many cases. So, the lead today was alpha's dead, and you can screw up beta, because we always talk about this. Peng Guo, we say, look, what is the China market? It's really hard to define. Is it A share? Is it stocks traded in Hong Kong? Because there's still a lot of big names that are traded in Hong Kong. And you see a very different return profile between Hong Kong and the mainland this year.
Yeah, that's probably should came from the MSCI's definition. So this is really like whoever business related to the China affected by the China market. That should be defined China related companies.
Yeah, this is a problem. You know, I started managing A shares in 2008, and I've been screaming this since 2008. Unfortunately, nobody's listening to us. We do still have a problem with defining the market.
That's true. Finally, we have to see the performance. That's the key.
At the end of the day, that's what it is. And again, for people who are watching us, they are buy and hold, set it and forget it. It's small allocation to China. And what we're seeing now is it's probably better just to pick those big beta names, set it and forget it. And also, like we always say, a little fixed income. Although,
that's right. That's what I'm trying to say. If you buy and hold fixed income, might be a good way.
Yeah, even though this year,
some of the equity, you can tolerate the risk.
Exactly. Even though this year fixed income has not done well. We'll get into that probably next week. But we're going to wrap it up with show A4. Thanks for tuning into the new season, and we'll see you next week.
Thank you.